Uber just reported $52 billion in revenue and $10 billion in net income, and that may be the best the business ever looks. Welcome back. Today we're examining the bear case, how autonomous vehicle economics, vertical integration by Alphabet and Tesla, and a structural margin problem could systematically erode what Uber has spent a decade building. As always, this is not financial advice. Do your own research before investing. Picture a Taylor Swift concert, letting out 50,000 people, pouring rain, everyone opening Uber at the same moment. Surge pricing kicks in. A human driver, 3 miles away, sees the ping, does the math, and declines. The unpaid time sitting in traffic, waiting for the crowd to thin, it costs more than the fare pays back. Now picture 500 autonomous vehicles that have been quietly parked 2 blocks from the venue since the opening act. No driver clock running, no earnings being foregone. They pre-positioned hours ago because waiting cost them almost nothing. So what does that waiting actually cost? For a human driver, sitting idle for an hour means roughly $23 in foregone earnings. That's a conservative estimate based on median driver hourly income. For an autonomous vehicle, the equivalent idle cost runs about 13 cents per hour, mostly power draw and remote monitoring overhead. That's a 180 to 1 difference. To put it another way, an AV operator can park a vehicle near a stadium all day for under $1. A human driver waiting in the same spot for 8 hours gives up about $186 in income they could have earned elsewhere. That asymmetry doesn't just make AVs more efficient, it makes pre-positioning at surge zones economically trivial for AV fleets and structurally impossible for Uber's current supply chain. And this isn't a theoretical future problem. In cities where AV services were active through late 2025, Los Angeles, San Francisco, Phoenix, human driver trips per hour dropped 5.3% year over year in the fourth quarter. Nationally, the comparable figure was 2.6%. So the decline rate in AV active cities is running at roughly double the national average. Hourly driver earnings followed the same pattern downward in all 3 markets. The mechanism is straightforward. AVs absorb the highest value trips first: airport runs, surge zones, stadium events, which are exactly the trips that make driving economically worthwhile for humans. What's left for human drivers is the lower margin, less predictable work. So we have a situation where AV operators can pre-position cheaply and are already displacing human drivers in early markets. The next question is whether those AV operators actually need Uber as a middleman. And there's a useful historical parallel here. When Expedia and Booking.com first scaled, hotels had no choice but to list through them. The platforms controlled demand discovery, and hotels paid commissions of 15 to 25% to stay visible. Then, as the platforms matured, hotels started offering direct booking discounts, loyalty points, room upgrades, slightly lower rates, to pull customers back to their own channels. Uber currently keeps roughly 40 cents of every dollar a rider pays. That's what the industry calls a take rate. Once AV operators have enough vehicles on the road to offer reliable coverage, that 40-cent margin becomes the exact incentive for them to build their own app and offer riders a cheaper fare directly. Expedia and Booking are still here as companies, but as public stocks, they have not been get-rich stories for most long-term holders, and the same has largely been true for Uber since the IPO. Versus the S&P 500, Uber and the 2 online travel names have trailed, and when you look at the NASDAQ 100, where Uber is a constituent, the gap to the QQQ index is even wider. So the OTA history is not just a strategy parallel, it is also an investing parallel, a hard-to-kill consumer layer that has still been a weak place to be, versus broad growth indexes. So about that take rate, let's make it concrete. On a $40 ride, Uber keeps roughly $16 or $17 and sends the remaining $23 or $24 to the driver. That's what 40+% looks like in dollar terms. Now imagine Waymo running that same route with no driver to pay. Waymo's cost is electricity, remote monitoring, and vehicle depreciation. If Waymo charges the rider $35 directly, undercutting Uber, it still nets more than twice what it would earn routing through Uber's marketplace. The rider pays less. Waymo earns more. Uber earns nothing. That's the direct booking math, and it's why Uber's take rate isn't just a margin metric. It's the exact incentive structure that makes disintermediation attractive to any AV operator with enough vehicles to go it alone. And Waymo isn't waiting for permission to run this playbook. The company raised $16 billion at $126 billion valuation, and it's expanding into Miami, Dallas, and Nashville on its own app without Uber integration. That matters because the partnership Uber has with Waymo in Atlanta and Austin gets framed as a signal of long-term alignment. But a company expanding independently into 3 new cities at the same time it's partnering in 2 others is telling you something about how it views that partnership. It's a distribution convenience during the early scaling phase, not a strategic dependency. And Waymo's CAC, the cost to acquire a new customer, is effectively 0. The app embeds natively in Google Maps. Android comes pre-installed on roughly 3/4 of the world's smartphones. When Waymo decides the partnership no longer serves it, the exit is already built. So here's where the first argument arc lands. AV vehicles can pre-position at surge zones for pennies, while human drivers can't afford to wait. That's already compressing driver economics in the earliest deployment cities. AV operators have a clear financial incentive to bypass Uber's marketplace once their fleet is dense enough. And Waymo is actively demonstrating, right now, that it's willing to do exactly that. The disruption mechanism isn't that people stop taking rides. It's that the margin Uber extracts on each ride gets rerouted. Rides continue. Uber's cut doesn't. Now, a common pushback at this point is that Alphabet and Tesla are software companies. They don't want to deal with parking lots, vehicle maintenance, charging logistics, and insurance claims. The thinking goes, the dirty work of running a physical fleet is beneath them, and they'll always prefer to let Uber handle operations while they collect a licensing fee. Amazon had the same reputation a decade ago. Then it built 800 fulfillment centers, a fleet of electric delivery vans, and a cargo airline. In 2025, Amazon handled 8 billion same-day and next-day deliveries, up 70% in a single year. That infrastructure was widely dismissed as too capital-intensive, too operationally complex, too far outside a tech company's core competency. Tesla built a global fast-charging network from scratch, not because charging is glamorous, but because owning the infrastructure meant owning the customer. Mega-cap operators will absorb brutal logistics work when the prize at the end is total market control. And here's where the capital war actually starts to matter. Alphabet reported a $3.6 billion operating loss from Waymo in the fourth quarter of 2025 alone. For most companies, that's an existential number. For Alphabet, it's roughly 2% of annual net income. The company generates about $164 billion in operating cash flow per year. It can absorb Waymo losses at the current run rate for decades without adjusting its dividend, its buyback, or anything else shareholders care about. Now compare that to Uber's full-year free cash flow. Even on an adjusted basis, it comes in well under $10 billion. So Uber's entire annual cash generation is less than 2 full quarters of what Waymo is currently burning. That's not a marginal disadvantage. It's a different category of opponent entirely. So Alphabet can outspend Uber indefinitely. But there's a second cost problem that's entirely separate, and it lives inside Uber's own partnership model. When Uber operates an autonomous vehicle, that single mile driven has to generate enough revenue to pay a hardware margin to the vehicle manufacturer, a software margin to the autonomy stack provider, a compute margin to whoever's running the AI inference, and then Uber's own platform margin on top. 4 different companies each need to extract a profit from the exact same trip. Tesla, by contrast, built the car, wrote the software, owns the compute, and runs the platform. One margin, 1 mile. In a market where rides are increasingly a commodity, where the rider picks whoever is cheapest, Uber's cost floor is structurally pinned above Tesla's. You can't negotiate your way out of a 4-layer margin stack. There's a third structural problem, and this one comes directly from Uber's own regulatory filings. Uber's entire routing infrastructure runs on Google Maps APIs. Waypoint calculation, ETAs, navigation, all of it. Uber's 10K explicitly states that no viable global-scale alternative exists. That means Alphabet, which owns Waymo, also owns the pipes that Uber's core product runs through. Alphabet can raise API pricing. It can slow Uber's integration priority as Waymo scales. It can do both incrementally in ways that are difficult to litigate and impossible to route around quickly. Uber has no credible mitigation in the near term Building a proprietary global mapping system is a multi-year, multi-billion-dollar project. So on top of the capital asymmetry and the margin stack, Uber is renting its operational foundation from its primary competitor. So to recap the cost problem before moving forward, Uber faces a capital opponent it cannot outspend, a partnership model that pins its per-mile costs above any vertically integrated competitor, and a foundational infrastructure dependency on the same company that's trying to displace it. Each of these is a separate constraint, and critically, they compound. Fixing one doesn't relieve the others. That's the structure of the problem entering the next arc, which is what Uber is actually doing about it on its balance sheet. So all three structural problems we just covered, the capital gap, the margin stack, the API dependency, those were about what Uber faces externally. Now look at what Uber is doing on its own balance sheet. The company has committed $500 million in equity to Lucid Motors and signed a purchase agreement for at least 35,000 Lucid robo-taxi vehicles. At roughly $50,000 per unit, that purchase commitment alone represents about $1.75 billion in hardware exposure. Uber spent a decade building its valuation on the premise that it would never own the cars. That premise is now officially retired. And that hardware commitment doesn't sit on the balance sheet quietly. It generates costs immediately. A 35,000 vehicle fleet depreciating over 5 years produces roughly $500 million per year in depreciation alone. Then add the physical infrastructure to support that fleet. Charging depots and maintenance facilities running approximately $136 million per year in real estate and operating costs. Then, commercial insurance, autonomous vehicle coverage runs meaningfully higher than personal auto. Call it another $300 million per year conservatively. Add those three lines together, and the Lucid commitment generates close to $940 million in annual fixed costs before a single fare is collected. To put that in proportion, it's roughly 15% of Uber's full-year free cash flow consumed by one hardware partnership. And then there's the charging infrastructure. Uber has committed over $100 million to build fast-charging hubs in Los Angeles, Dallas, and San Francisco. That capital goes into concrete, electrical grid hookups, and long-term real estate leases. Assets that depreciate over decades, not quarters. The balance sheet profile of a company that owns charging hubs in 3 cities looks a lot more like a logistics utility than a software platform. That matters for how investors price the business, which is exactly where the next part of the argument lands. Here's why the balance sheet pivot matters beyond the cost numbers. Uber currently trades at roughly 14 to 17 times EBITDA, a multiple consistent with a high-margin software platform where earnings grow with minimal incremental capital. Hertz trades at around 6 to 8 times EBITDA. Avis is in a similar range. Fleet operators carry lower multiples because their earnings are cyclical, capital-intensive, and tied to depreciating physical assets, exactly the characteristics Uber is now acquiring. If the market reprices Uber at 8 times EBITDA, a reasonable midpoint for fleet operators, and we hold EBITDA flat at roughly $10 billion, the implied enterprise value comes out around $80 billion. Uber's current market cap is about $158 billion. That gap, roughly 50%, isn't driven by a revenue collapse. It's driven entirely by the market reclassifying what kind of company Uber is. So take the multiple compression math from the previous section and apply it to a specific scenario. If AV deployment continues at its current pace and Uber's take rate compresses from roughly 41% down to 30% by 2028, a 10-point drop, not a collapse, revenue growth stalls and EBITDA likely falls into the $7 to $8 billion range. At that point, if the market reprices Uber as a fleet operator rather than a software platform, you're looking at an 8 to 10 times EBITDA multiple. That math produces an implied equity value somewhere between $56 and $80 billion. The current market cap sits around $159 billion. That's a 50 to 65% drawdown, and it doesn't require Uber to lose a single customer. It just requires the market to agree on what kind of company Uber has become. Now, to be fair, the bull case has real foundation, and it's worth stating plainly before pushing back on it. Revenue grew 20% to reach that $52 billion figure. Net income came in above $10 billion. Uber One membership hit 46 million subscribers, up 50% year over year. The platform is generating substantial free cash flow, and at roughly 16 times earnings on a 20% growing business, the PEG ratio sits around 0.8, which is objectively cheap on trailing numbers. If you're an Uber bull right now, you're not working from bad data. The business looks strong. The bear case isn't about what Uber has already built. It's entirely about whether the structural forces now in motion will erode the economics that produce those numbers. That's a timing and trajectory question, not a current state question. The strongest version of bull argument goes like this. AV operators actually need Uber during the scaling phase. Waymo can't manufacture consumer habit from scratch in every new city. Uber brings 9.7 million active drivers, an established rider base, and a booking interface people already trust. The partnership in Atlanta and Austin generates commission revenue for Uber without any capital deployed. Uber One's 46 million subscribers represent real switching costs, people who have their payment details saved, their preferences set, their work accounts linked. And the advertising business layered on top of that membership base could eventually become a high-margin revenue stream that partially cushions any take-rate pressure from the supply side. These are structural advantages, not wishful thinking. The question is how durable they are once the AV supply side matures. The problem with that argument is that Waymo is already showing us the answer. If Uber's demand aggregation were structurally necessary to AV operators at scale, you'd expect Waymo to stay inside the partnership as it expands. Instead, the Miami, Dallas, and Nashville expansions are happening independently. No Uber integration. That's not a prediction about future behavior. It's observable right now. The partnership is clearly useful to Waymo, while its own fleet density is thin. But the moment AV coverage reaches the point where a rider in a given city can get a vehicle in under 5 minutes without opening Uber, the demand aggregation argument goes away. Consumers follow price and wait time, not platform habit. The switching costs that protect Uber One today are soft enough that a 15% price discount on a native Waymo app would erode them quickly. The ride-hailing business isn't the only segment carrying structural risk. Uber Eats generates roughly 3% contribution margin per order, meaning for every $10 in food delivered, Uber nets about 30 cents after paying couriers and subsidizing the platform. That's a thin enough margin that a single, well-capitalized competitor offering bundle delivery can make the economics unworkable. Amazon delivered over 8 billion same-day and next-day items in 2025, up 70% in a year, using hub-and-spoke fulfillment infrastructure that Uber's point-to-point courier model can't replicate. When Prime membership already covers the delivery fee, the consumer has no reason to open a separate app and pay again. Uber Eats' vulnerability is structurally independent of everything we've covered on the ride-hailing side. It's a separate pressure, compounding at the same time. So what does the risk and reward actually look like at the current price? At around $159 billion market cap, you're essentially making a bet on timing. The bull scenario, AV disruption pushes past 2030, Uber One deepens its hold, advertising scales into a meaningful margin buffer, could support an enterprise value somewhere in the $200 to $220 billion range. That's roughly 25 to 40% upside. The bear scenario, take rate compresses as we walked through earlier, the balance sheet gets repriced from software platform to fleet operator, points toward that $56 to $80 billion implied value range we covered in the multiple compression math. That's a 50 to 60% drawdown. The asymmetry is what matters here. The upside case requires a decade-long disruption delay, while the downside case requires only that Waymo's current expansion trajectory continues for another 2 to 3 years. A bear thesis is only useful if you know what would change it. 3 conditions would cause me to reconsider this one. First, if Uber acquires or licenses a vertically integrated AV stack, something that closes the cost gap with Tesla's single-margin model, the margin stacking problem we covered earlier gets materially addressed. Second, a serious AV safety incident or regulatory restriction that delays commercial deployment in major markets past 2030 buys Uber's current economics several more years of durability. Third, and probably most important, if Uber secures contractual take-rate protections from its AV partners before fleet density makes disintermediation economically optimal, the disintermediation thesis loses its mechanism. The key variable isn't whether AV technology works. It's whether Uber can lock in its margin position before AV operators are large enough to walk away from the partnership entirely. If you're tracking this thesis going forward, 4 signals are worth watching closely. First, the pace of Waymo's city expansions, specifically whether new markets launch with or without Uber integration. Each independent launch is a data point on the partnership's durability. Second, Uber's take rate in AV active cities over the next 2 to 3 quarters. If that number starts drifting below 40% in Los Angeles, San Francisco, or Phoenix, it's the earliest measurable sign of structural margin erosion, not a prediction, an observation. Third, capital allocation disclosures. More hardware commitments accelerate the asset-heavy pivot. A buyback acceleration would suggest management sees the balance sheet pressure differently. Fourth, any disclosed contractual agreements with AV partners around take rate floors. That last one would be the single most bullish disclosure Uber could make right now. So here's where everything lands. Uber's 2025 numbers, the revenue figure, the net income, the gross bookings, represent what peak aggregator economics look like. The platform captured a fragmented supply chain of millions of independent drivers and extracted a 40-cent margin on every dollar that moved through it. That model worked because the supply side was too atomized to fight back. What's changed is that the supply side is consolidating into 3 companies with trillion-dollar balance sheets and a clear financial motive to route around Uber entirely. The structural forces we've covered, the idle cost asymmetry, the direct booking incentive, the margin stacking, the forced hardware pivot, these aren't sequential risks. They're running simultaneously. And Uber's own disclosed commitment suggests the asset-heavy transition is already underway, not a future possibility. The bear thesis doesn't require Uber to collapse. It requires the market to eventually reprice a fleet operator as a fleet operator. That's the bear case on Uber. Whether you're long, short, or just watching from the sidelines, the structural questions here are worth tracking closely. If you have a different read on the AV partnership model or where Uber Eats fits in 5 years, drop it in the comments. I read everything. Thanks for watching, and I'll see you in the next one.